Let's take a look at the broader market here because the S&P back in the red today as big tech sells off. Microsoft and Google leading to the downside following their disappointing earnings results. You see the S&P off just around 0.7%. NASDAQ actually off nearly 2% this afternoon. Here to talk about that and some of the broader trends at play, we want to bring in Tom Lydon, VettaFi's vice chairman. He joins us for this week's ETF report sponsored by Invesco. QQQ. Tom, it's great to see you. The slide that we're seeing in tech, I know you recently just wrote about ETF fund flows when it comes to some of those tech-specific funds. What do you make of today's news, and what do you think that's going to mean for investor appetite there?
So when you look at the big picture, coming out of the financial crisis, it was all about FANG stocks, Microsoft, those tech stocks that really drove the S&P to, it was really tough to beat. No active managers could really touch it. Now, in the last couple of years, S&P's been challenged, and we're seeing more of that with these mega cap stocks being challenged in the market. What that does mean, too, is it's better for some of these actively managed ETFs. For the first time in 20 years, we're seeing active managers actually outperform some of their indexes, counterparts that they benchmark against. So that's good for the ETF business because active management has really made it in there, number one. Number two, there are also great opportunities outside the mega cap area, outside the S&P 500. Small caps in the last 3 months are up almost 8% compared to the S&P that's only up 3%. So diversifying away from these big companies is important. And also, when you look at small caps, just because of the strong dollar, multinationals are affected overseas, we know that. But there's a home country bias with small caps where they can buy goods and services overseas and do most of their business in the U.S. And then finally, quick shout out to stocks overseas. I mean, listen, those markets are challenged, and in many cases, in emerging markets, you've got multi-generational buying opportunities where they're single-digit Ps there, and although it doesn't feel good, the currencies is working against you. If you've got a long-term outlook like you guys do, who are a lot younger than me, you could buy some now and just forget about it for a couple years, but you're not going to see buying opportunities with these low PE ratios that you see now. Yeah.
Speaking of overseas challenges that could to some represent opportunities, Xi's third term in China hammered Chinese big tech stocks, Chinese stocks represented here. Is there opportunities there in the ETF space?
Well, Peter Lynch said, don't ever let a bear market opportunity go unused or something like that. I'm kind of paraphrasing that. But it not only from a technical standpoint, a governmental standpoint, all the saber rattling that's going on, and then the whole delisting thing that's happening, that's really key and important. But we have to know that timeline is not the next 3 months. It's actually the next 2 years. So we've got some time for that delisting thing and the accounting thing to be worked out. And also, with that being said, you look at some of these companies like Baba, they're not going away. And they're going to continue with all the online buying that's happening and going to continue to grow. The fact that most of the citizens in China don't have laptops, they don't have desktops, they do everything off of their phone, and all their buying and purchasing happens there. There are companies that are set up there to take full advantage of that. And the valuations have come down tremendously, where you could buy some of these ETFs like KWEB, which is online buying China, which has just been devastated price-wise. But the crazy thing is shareholders are staying tough. They're not selling. Actually, some are doubling down because they see this as a buying opportunity.
Tom, you mentioned the strong dollar, obviously a huge headwind. We've heard about it from a number of CEOs who have reported earnings over the last couple of weeks. We're seeing the dollar index pull back just a bit today. But when you see the strength of the dollar here, what do you think that means just from an investment standpoint? And then if you're looking to capitalize on this through ETFs, what should people be doing?
Well, as Katie said in the last segment, it's tough to find a trend. When you fight a trend, you've got to have some pretty big guts. Right now, with all the uncertainty in the marketplace, people are going towards safe havens. The dollar's a safe haven for sure. And as we continue to see rising rates, Fed's pretty clear about signaling, which is a good thing. They're telling what's going to happen. And since they were pretty clear about that in May, all of a sudden there's been more confidence in the market. We see from the advisors that we're surveying regularly when they were selling bonds have now actually come back into the bond market because there's more clarity along with these advanced yields. So that's really, really good. What we can't count on is stability overseas, and that's the scary thing. But while there is an instability, ETFs like UUP, which is in the Invesco long dollar, there's an opportunity that if you want to hedge against continued problems overseas with foreign currencies and instability in governments, that may continue to do well.
VettaFi's Tom Lydon. It was good to see you, sir. Thanks for being here in the studio.
Seana.